All right, hey guys, Kevin here. This is video lesson number 10 in your calendar course. And I have decided a couple of things. All right, I have decided one, I'm going to make this the final video lesson. 10 individual videos is plenty. I kind of feel like maybe in the last video, I began to ramble just a little bit, showing example after example after example, and I do not want to waste your time, so I do apologize a little bit for that. But number two, I want to spend this video lesson just going over the top probably 20 questions that I think are important to understand about calendar trading. Now, I am accessible. If you are listening to this video recording right now, that means you have purchased a premium course from me. Now, you will have 100% access to me via email, in the forums, in the threads. If we need to do some one-on-one mentoring sessions, just because the course, you've gone through the course, doesn't mean that all of the material is loaded just in that course. And I think that was probably what I was trying to accomplish in the last couple of videos, is just put so much information in there that was coming to my mind to just give you guys as much value in this content as possible. So I want you to know that I am here for you, and if there are specific questions or struggles or challenges when you finish this lesson, this course, these 10 videos, and you get through to the end, and if your head is still just swimming, you don't really understand, it's too much, just please reach out to me and just let me know, okay? Because I do not want you to try and tackle this on your own. Please try not to get discouraged, and please don't go this on your own. I can absolutely help you. So let's just go ahead and get into this. This will be the last video lesson, and I think that it should be a good one, just to kind of tie everything together, and then just talk about just kind of an overview, just a general wrap up, a recap of the all the calendar lessons that we have talked about. So let me minimize that. I think I love this picture here, and yes, I am a rock climber. No, this is not me. I have been on big walls before, but I think that it's pretty powerful of an image, because when you're first starting out, right, you're looking at just all this distance, just you're leading off into nowhere land. But if you arm yourself with knowledge and education and some information and some, align yourself in a partnership with somebody who has done it and has been there, I guarantee you that these two guys right here that are climbing up this wall, probably several hundred feet off the ground, it's in Yosemite somewhere, or Tuolumne Meadows, I'm pretty confident that they're skilled and they're confident in their abilities. And so, it's no different whether it's rock climbing, whether it's options trading, whether it's real estate investing, whether it's race car driving, whether it's, bricklaying. It doesn't matter what the situation is that you find yourself in. The way you get better at anything in life is just by doing it, and by practicing it, and by failing, right? Every time you fail, you're going to learn something more, and then you stand up and you persist and you go again. And if you don't quit and you learn something every time you fail, guess what? At the end, you will find that you will have the ability to walk and run and truly enjoy what it is that you're seeking after. So on that note, let's just jump in. But I love this image. This is what I have set as my background on my desktop on my computer. And it's a great visual. It's an awesome image. I would love to many times just close my eyes and put myself right there, unplugged and on that rock. So let's just jump on in. So calendar, let's just recap. I spend a few minutes just recapping calendars, and then I'm going to just run down through just 20 questions that I have printed out that are, I think, probably the top questions I'm asked that I asked when I was starting out. And I want to just make sure that I give you guys clear, distinct, concrete answers to them. So calendar trading can be really viewed as one of two approaches, right? I'm going to just pull up this thread here. We are either generating a delta neutral approach, meaning we have no opinion on where the market is going, or we have a directional approach. We want to express and we want to put our bias on a trade. So if I see the SPX right now at 2047, today is May 17th, 2016, and we've had a pretty good down day today. If I come right at the market and I say I have 59 days in which these options expire, I have 94 days in which these options expire, I am delta neutral, I am at the money, I have a risk profile graph that looks like this. The market could go down, the market could go up. It does not matter to me because I will begin to lose unrealized profits equally if it goes down or if it goes up, okay? So that gives you that delta neutral approach. We are selling options that expire before options that we have purchased. Therefore, we are a theta positive position. We are a vega positive position because the options that we are purchasing have more time to expiration, they are more expensive, and they are subject to more vega. All right, if I change this right here from delta to vega, all right, vega at 327 is less than vega at 412. So they have more sensitivity to vega, and these are options that we have purchased. So a delta neutral approach is one way to trade a calendar method, calendar strategy. A directional approach is another way. I can say if I am bullish on the SPX and I want to construct something at the 2150 strike price, you still construct a calendar trade, but you are saying, I am bullish. I know that I want to accept this risk of the market moving up, and if it does, I begin to make immediate profits because I am delta positive. And if I move up even just a little bit, I begin to generate profits, unrealized profits. If I move down, I am going to lose those unrealized. I'm going to accept an unrealized loss. They don't become realized until you close the trade, right? Conversely, if I want to construct something to the downside with a bearish bias, same thing. I want it to move down. I have an opinion that it will move down. Therefore, I can construct a calendar trade to take that assumption and plant a trade out of the money. So one of two things will happen. Either you trade delta neutral, you have no opinion, and you just let the market go where it wants to go, and you close it up at profit or you close it up at loss, or you adjust and fight and you defend a position, or you construct a trade that attempts to take a directional posture, and same thing. You either close it up at max loss, you close it up at target profit, or you add capital to it as it goes against you, or you fight it. You know, the management is very similar, but the construction is different. So right off the bat, a calendar trade can be constructed either directional or non-directional. My personal preference is I like trading non-directional. I like to have the market tell me where it's going, and then I just react accordingly. That doesn't mean that I don't ever trade directionally. I do, but the bulk of my trades are non-directional. So a calendar trade setup, all it does is it uses two different expiration cycles. And again, I've already went over this in great detail in other video lessons. I'm just wanting to kind of tie everything together and recap this at the end. So we have two expiring sessions, we have this cycle expires in 59 days. This one expires in 94 days. This one expires in 3 days. This one expires in 59 days. We can construct a calendar utilizing any expiration cycle we want. But the definition is a calendar trade has to have the same strike price utilized, and it has to have a short option expiring before a long option. If you did the reverse, then what you are doing is you are naked selling options, and you are selling a calendar. You are essentially saying these are going to expire before these, and while yes, it looks similar to a straddle type trade, which is another method and another lesson that we can talk about later, when these expire, if you still have these open, this is unprotected, unlimited risk of loss. So the calendar setup is always having two different expiration cycles, same strike price, same underlying vehicle. So that is the, in a nutshell, that's what we're referring to with calendar trade. So 11 minutes into this already, guys. I'm so sorry. I really do try and be mindful of your time, but I do not want to shortchange you either. I want to get this information out there to you that I think is super important. You paid money for this, so I want to make sure and give you value. Now, let's just go through the top 20 questions that I get asked that are pertinent to calendar trading only. There will be variances to there will be similarities between a calendar and a butterfly, or a calendar and a debit spread, or a calendar and a condor. But right now, let's just focus purely on calendars. And probably the number one question I'm going to get asked, and it took me a little bit of time to understand it, is, all right, well, what is the difference? So question number one is, what is the difference between a calendar and a diagonal, right? It is the same exact setup. The only difference is, instead of the same strike price, you are picking a different strike price. So a calendar trade, it can be set up as directional or non-directional. Same with a diagonal trade. It can be set up as directional or non-directional. The diagonal trade, however, if you set up a diagonal trade that is like this, all right, you start out in a non-directional system or a approach, but you can see that you have maybe a longer time horizon for a bullish move, but you want to let the market come to you and say, all right, I'll give it a little bit of wiggle room to one direction or the other, depending if you're using calls or puts, but I am still leaning a little bit with a directional bias. So the number one difference between a calendar and a diagonal is going to have to do with Vega. If I have a calendar trade right here, my Vega is 89.75 plus 89.75. And what that represents is, for every 1 point increase in volatility, I will make, theoretically, these are just models, okay, they're not absolutes, but I will make $89.75. If I have a 1 point decline in Vega or volatility, my Vega tells me I will lose $89.75. The benefit or drawback, however you want to look at it, with trading a diagonal is now I can change how sensitive my spread is to Vega, but I also have to understand that's going to come at a cost of delta. So if I keep the same strike price, I'm pretty delta flat. My theta is plus 10, my Vega is 89. If I separate the strike prices, my delta is very negative, my theta is still positive, my Vega is 47. So the number one biggest takeaway difference there is that with a calendar, you are going to change all of your Greeks, but the most important Greek you're going to probably be changing, and the reason you're maybe doing a diagonal instead of a calendar, is to have less exposure to Vega. All right, so question number 1, calendar and a diagonal. Now, question number 2, when should a calendar be used instead of a debit spread? Now, debit spread. We have to understand what a debit spread is. A debit spread is a debit from your account. So if I am staying in the call side, I will say I am buying one option and I am selling another option. That is a debit from my account. That is a call debit spread. Therefore, I have defined risk, I have defined profit. That is a directional trade. Now, when would I want to use that instead of a calendar, you might ask? Well, that's a delta neutral trade. I have 31 days to expiration. I still have 31 days to expiration if I come in here and I have a delta positive trade. All right, I am really wanting this to move to the upside. So when I would consider using that over a calendar is I want to go back in time just a couple of weeks here, okay? Because this kind of leads into question number 4 about optimum timing for calendars. But if I have a certain time period, now say that these options are going to expire in 18 days. Let's go to the end of the week. So we've got Friday, May 6th, 2016, and for whatever reason, I'm wanting to put a trade on. I think the market condition warrants me putting a trade on, and I'm ready to go. I think it's whatever the reason is, you want to put a trade on. So I have 14 days to expiration. I have 42 days to expiration. Let's just say that I am very bullish on the market at this point, and I want to put on a bullish call calendar. That's what I want to do. Now, I have very little time to expiration, so an $1,100 trade that I have essentially 14 days to be in, if I converted that trade and said, all right, well now, instead of doing that, let me do something like this. All right, so I have an existing calendar trade that's got a bullish bias. I have a debit spread that has a bullish bias. All right. Why would I want to use a debit spread instead of a calendar, or vice versa? I would, if I have less than 20 days, say for example, or even 21 days, 3 weeks, you're coming close to expiration and you want to put on a directional trade. I can put on a $200 directional debit spread that if we move from where we currently are to say 2100, all right, that trade will theoretically bring in about $662. Compare that to an existing trade, an existing calendar that has a lot more margin, and if we move up to 2100, well, it's going to bring in got to make sure I'm on the dotted line. It's going to bring in $333. All right, so the differences between that one and this one, right? You've got a lot more profit that is going to be coming into this trade, almost double and then some, for much less risk because you have much less time left in these options. Now, if you are wanting to execute trades in a different expiration cycle, well, if I am bullish or if I'm bearish, then I would want to use a calendar approach instead of a debit spread. I could still use a debit spread. Again, it's still going to give me the same construction, but you'll notice that I have a much flatter directional T+0 line than if I were to do something like this. Okay, I have a much different slope to this one, and I have much more theoretical profit in the calendar, primarily because there's more days to expiration. So that's going to hinge all upon how much time is left until the options expire. So if there are less than 20 days and you're directional, I would consider a debit spread versus a calendar. If you have greater than 20 days, a calendar or debit spread, either one would work fine for a directional move. For a non-directional move, then of course we're using only calendars. So question number 3, why should a calendar be used instead of a butterfly? All right, butterfly. Well, let's talk about that for just a quick second. If this is a butterfly, we have options all in the same expiration cycle. This tent looks very similar to a calendar. We've been watching lots of videos about what a calendar looks like. This looks very similar to a calendar trade. If I convert that trade and say, all right, here's the existing, that's the existing butterfly. This is the existing calendar. I superimpose the two. They look very similar, right? I mean, we can agree that they look quite similar a lot. What I want you to notice is green is the butterfly, magenta is the calendar. The calendar has a lot more tail risk at the end, both on the downside, both on the upside, as well as if I have an existing trade, which is a butterfly, when all of the options are in the same expiration cycle and I simulate a 10% increase in volatility, my expiration graph never changes. It does not change one bit no matter what happens to changes in volatility. Now the T+0 line obviously changes, but the expiration graph, I know what my trade is going to be valued at expiration. It will never change. Therefore, I can make strict and very precise calculations on my risk management and my money management compared to if I have a calendar trade and my volatility goes up 10%, well, everything goes up. The T+0 line changes, the expiration profile changes. If it decreases by 10%, everything changes again. So the single biggest drawback to trading calendars is related to this question right here. Why does a calendar operate differently than a butterfly? And it's because you have options that expire in different expiration cycles. These expire in 42 days. These expire in 70 days. These are going to react to changes in volatility much differently and at a different percentage and ratio and a different relationship than these. So you have a much more difficult time calculating true risk management and true money management when you're saying, all right, well, there might be $3,600 profit in this trade, but if I get a 3% decline in volatility, well, now there's only $2,100 of profitability in this trade. So again, it's that expiration profile is floating, and that is the single biggest primary difference between trading a butterfly and trading a calendar. My personal preference are trading butterflies. However, calendars, you have to get through them so that you understand when they are appropriate and when they are relevant to trade instead of a butterfly. We talked a lot about that in video lesson number 8 with earnings and news events. Okay, so question number 4, what is an optimum time to place a calendar? Okay, great question, and I took that from one of the forum posts. There is no perfect or right or wrong way. But now there are optimum times to place calendars. We talked a lot about that in prior videos. When you see this skew get positive, meaning the front month options are greater than the back month options, and you have anywhere between 30 and 60 days to expiration on these front month options, in my opinion, and it is my belief that those are ideal or the optimum times to place calendar trades. Now, you can still make money on calendars if that scenario does not play out, but that is an optimum time. You get more exposure to danger and to quick big moves as you get closer to expiration. You can still make money at 14 days to expiration. You can still make money at 70 and up, 70 and 105 days to expiration. But that kind of sweet spot, if you will, is usually between 30 and 60 days for your front month options. So you can have 34 days, sell one, buy one farther out in time. You can have 55 days, sell one, buy one further out in time. But what's really good to pay attention to and to notice is, what is the skew doing? If you have a gigantic negative skew, it's going to be really hard no matter what your timed entry is. If you have a really good positive skew and you're still 90 days out, well, that might not be as ideal as just coming into the next closer expiration cycle without coming too close to expiration. Because what we're talking about here is targeting percentages of margin deployed, and if we deploy a trade that has, say, $2,500 worth of net margin, and we are targeting 10% of that, all right, well, if we're only targeting $250 and we have a big vol crush at the beginning, in the first couple of days, we can easily hit that target right away. But the reverse is also true. You can hit a max loss pretty much right away. So double-edged sword there, all right? Now, question number 5, when is less than ideal to place a calendar? All right? Well, less than ideal is just the reverse of what I just said, right? I mean, I kind of led into that. A big negative skew. This is much lower than the back month. You're getting too close. You're getting way too far. I mean, this would not be... You could certainly place a calendar like this, and you could say, well, let me sell one at 70 days, and let me go way out here to 133 days. That's still a calendar trade. It's a complex long-term calendar trade, but you have 70 days for these to expire. You have 133 days for these to expire. You still have delta neutral setup. You still have theta positive. You still have vega positive. You have defined margin, and you can construct a trade plan. So the less than ideal time is if this were, say, 12 right here, and I would come in way too close, and I misunderstood, or I thought I was being fancy, or I read something that somebody said to do this, and I say, well, you know, I'm gonna sell this and I'm gonna roll it every single month because I've read that that's the best way to trade calendars. You know, you take on a lot of risk. You take on a ton more risk than I believe is necessary when these options are really close to expiring and you have a very large 12.7 to 15.8. You have a very large negative skew. So less than ideal circumstances right there. Question number 6, when do you consider adjusting a calendar instead of closing? Great topic that I've done videos on in the forums. We've talked great length about the we did a whole webinar where I spent almost 30 minutes. I can look up the date and let you know, but and I just want to look up the date. It's the option webinar from May 5th. So it was the day before what's on backtester mode here. On May 5th, 2016 webinar I did, we spent a lot of time talking about rolling and defending a position, how to sell naked puts when you're bullish a stock, and a few other topics. But when you have a trade on, if you are in a position, where this is your trade, and let's just say this is your calendar, and you've been in this trade for 3 weeks, and you are now getting into a position to where you are coming at an adjustment point, a decision point when you need to make an adjustment. What I think is very important to ask yourself is, if I were flat right now, if I didn't have this current position on and the market was trading up in this area here, and I was planning on either adding more capital to it or selling and rolling, if I have a trade that now looks like this because my risk profile has me way up in this area, all right? If this is the trade, if this is the existing trade and I'm up here at, say, 2096 and I'm down a couple $100, $120 some, and I want to plan an adjustment, well, at $120, I'm not going to be up money right here. I'm not going to be up 170. I'm going to be down 120, but this expiration risk profile graph will be what the new position will be in. If I were flat in the market, would this trade be something I would put on? And that's a simple question you just have to ask yourself. If I were flat right now and I made a trade, would this be something that I believe in? And if you can't say emphatically yes, then don't make the adjustment. Close your trade, take your loss, wait for the next trade setup. Because what happens inevitably is you add more margin, you get closer to expiration than when your original trade was put on, and you get married and you get very emotional to it. You get into a relationship with a trade that you've already been in for maybe a couple of weeks, and now you get a little less logical. You get a little less objective. You get a little more emotional, and you begin to fight a little harder. And all you have to do is ask yourself, if I were flat right now and I felt like putting on a 2 or 3 legged trade with multiple calendars across multiple strikes, is that something that I would believe in? And if you can answer honestly yes, then make your adjustment and manage your trade. If you cannot, then just close it. All right? So, question number 7. What are target profits and maximum loss reasons and rationale? Why do I talk so much about that? Well, that's gonna circulate and rotate around trade management and money management. If I am putting on a trade as a at the money call calendar right here, and I know that it's going to cost me $1,300, I have one of 2 ways to approach that trade. Either I'm prepared to lose all $1,361, and in exchange I'd like to make the same or more. Well, if I am prepared to lose $1,361 and I've accepted that as my risk, and I know that the most I'm going to make in this calendar is in upwards of $1,700, providing there are not big changes involved, right? We talked about that a couple questions ago. Then I need to know at the beginning, what am I willing to risk? What am I willing to target? If you are an elite athlete in archery or target shooting, or any sport that requires you aiming at something, and you just go off not really aiming at anything, you're never going to know if what you're doing is working or not. So set a target, accept a maximum loss, and then aim for that. And if you hit it, close your trade. And as you do that over and over and over again, you build confidence in the method, you build confidence in your abilities, you develop understanding on how these options actually work. Okay, so that is why I believe they are so important to know up front. And then you need to be able to tell yourself that you will respect those targets or those assumptions as the trade begins to grow and as it matures closer to expiration. So question number 8. What is skew and why is this so important? Skew, simply stated, is the difference between one option and another. If I have an option here that is selling, if I sell this option at 13.8 implied volatility and I am buying this option at 14.9 volatility, that negative skew is I have one option that is less than another. It's no difference than saying if I am buying this option here and I am selling this option here. That is a negative skew. This one is less than this one. Now, you'll notice that I can come at the money for a 2050 call calendar. And let me just convert that trade. That trade looks like this. That trade will set me back $1,361. I can do the same thing on the put side at the money. I can say a 1361 trade in the call side is now a 1533 trade in the put side. And why is that? That is because of skew. That is because of the differences. You have a negative skew from the front month to the back month. You have a negative skew from the front month to the back month. However, please notice, take note of this. This implied volatility on the calls is always going to be less than the implied volatility on the puts. And the simple fact and the simple reason that is markets do not crash to the upside. They surprise crash, move to the downside, and far out of the money puts are priced at a high implied volatility, 21.9. Far out of the money calls, lower implied volatility, 10.7, 11.4. Markets don't crash to the upside. They crash to the downside. So that skew, that put call skew, the calls are always going to be, well, all right, let me back up. Not always. There are special circumstances. Very, very, very seldom are the calls going to have a higher implied volatility than the puts. All right? So that is what skew is and why it is so important to understand. Okay? Next question. Question number 9. What is ideal price to traded calendars? So an ideal price to traded calendars really is anything that you can accept that you're willing to send out to a trade. We use the example of the SPY. You can trade these for as little as $50 or $100. You can trade these in the NDX for as large as $10,000 and up. So as far as an ideal price to trade your calendars, that's going to kind of return back to talking about skew. If this is, say for example, 38.50, and let's say this is 49, well, if that skew right there, if I execute this trade, and those are my fill prices, all right? If I went right into the market right now and reverse that trade, you'll see I make a fairly good return because of the pricing. I got a very good price on both options. Now, the flip side of that is, let's say I get a really bad price on this one, and I get let's see, let's go less on that one. Let's say I get a really bad price on this one, and I get a really bad price on this one because of that negative skew again, 13.1 and 16.1. Well, if that is my trade, this is what I currently have. Black dot represents profits. And this is my existing trade, right? All right, so the T+0 line is elevated. Well, now this T+0 line that is now down here, forget about the black dot just for a second. If I executed the trades at this level, well, I am getting a much worse fill. I can just delete that to show you. All right, so delete. -1 +1. So if I get a worse fill, I do not get as much credit on the front month, and I have to pay up a lot on the back month. Big negative skew, right? I mean, huge negative skew. Well, if I convert that trade, I mean, look at that. Just the pricing alone can really devastate a trade and make it to the point to where it's almost impossible to recover. So as far as what I think is an ideal or an optimum price to get a calendar at, it's more important to pay attention to the skew. Don't enter these calendars when there's a big negative skew, and certainly don't force an issue to get into a trade. If you've identified an area and you've identified a fair market value price because you've been watching it and you see that the trades that have executed are around a certain price, put your order in around that certain price. And if it gets picked up, great. If it doesn't, don't chase it. There will always be another trade right around the corner. All right, question number 10. How much open interest and volume should a vehicle have? All right, super important. Super important to take a look at. Let's do this. All right, so let's look at, say, the SPY. We talked about this the last video. We used SP as the example. If I have a trade and I'm wanting to enter a trade that has no open interest, I am the only market. All right, I am the only one that's wanting to trade. And if there's no volume, nothing has transacted. If I go into the SPY and I say, all right, 31 days to expiration, I have penny wide spreads, I have a lot of volume, I have a lot of open interest, I have no trouble getting in and out of trades. My rule of thumb is I'd really like to see on the underlying asset, if it's an equity, meaning if we went into Amazon or Apple or Chipotle or whatever the case may be, I would really like to see at least a few hundred shares of volume, and for sure a few hundred. I'd like to see 1,000 shares of open interest. That makes me a lot more comfortable. It makes me feel a lot more secure that I'll have no trouble getting in and out of a trade. So you'll see that right here, Chipotle's had several hundred. We've had, fair amount of volume. We could go into, I don't know, what is this one? DuPont. DuPont has okay, but it doesn't have a lot. It gets out of the money pretty quick. You could look at IBM as a good one. There's lots of volume, lots of open interest. So, again, a good rule of thumb is just make sure that there's enough and make sure that the spread, the bid-ask spread, is close enough. Penny-wide spreads are the best. Then you do not give up so much on slippage and execution. Question number 11. How many days to expiration are suggested? Well, I kind of already talked about that one of the prior questions. Ideally, anywhere between 30 to 60 days seems to be that sweet spot. When you start getting under 30 days, that option decay curve really begins to accelerate. You get a lot more gamma risk. The acceleration factor really starts coming in, and you can see difference between 15 and 43 days right here. This option's valued at 21.25. This one's at 36.88. So there's still plenty of premium out here with a lot more distance between you and the expiration cycle. Question number 12. What kind of gap risks exist with calendars? All right, that's primarily in equities. Did a whole lesson on how to trade earnings, how to trade news events. In the big basket, the big indexes, the ETFs, you very rarely and very seldom will you have to be concerned with a gap risk. It's there, but it's more prevalent with equities and all the surprise announcements that come around with them. You can certainly have the gap risks with the ETFs and with the indexes, but if you look at a chart like this, which is the SPY, much fewer gaps and much fewer surprise announcements than if we went into something, say, like Priceline, for example. if we go into Priceline, if we look at a price chart of Priceline, I mean, there's some really significant gaps. You know, we'll go weekly back here. There's some pretty significant gaps that don't fill, that run away, and so those are the biggest risks if you are trading a non-directional approach in a calendar and it just blasts outside of your expiration profile tent and you have no chance to recover it. That may be a time to consider saying, all right, well, if that's what I'm going to accept and I want to trade this, well, there may be no fighting or no adjusting or no battling this trade. That's the full risk, that's the full margin, and if I get a gap way out and there's no way for me to adjust it, all right, then I just have to count that as a loss. But do not close the trade. Leave it open, because you still have that chance. If it gapped out and it came back, sometimes just that small bit of coming back will take a 50 or 60% drawdown trade, at least back to break even, and sometimes back even into profit. So those gap risks are more prevalent in equities and those types of underlying assets. Not so much in the ETFs. Still there a little bit, but not as much. All right. So question number 13, when are preferred times to adjust a calendar? All right. Well, preferred time to adjust a calendar is if you have identified in advance that you are prepared and you want to adjust, you want to battle, you want to gain experience, you want to gain knowledge. It's not so much about making money, it's more about learning how you handle adjustments and how these options behave, and asking yourself that simple question. Let me go back in time a little bit here, and we'll just run through a quick example. Because we could say I put a trade on, let's put a trade on right here on 411. So I want to say and assume I put a trade on right here. If I put a trade on 411, I have 40 days to expiration. I'm at the 204 call strike. I sell one, I buy one. All right. So here's my trade. And if I get up to this edge at 209, well, then I need to do something. So let's say we get up to that point, which I'm pretty sure we do, I just don't remember the date. All right, well, there you go. How's that for, well, actually we did get to it a little bit sooner back here on the 20th. I thought, well, how lucky would that be? So, with a preferred time to adjust a calendar is when you are in a position and you say, all right, well, I've identified that expiration break-even point as a time when I need to make an adjustment. And I've already told myself I will scale in tranches, and I'll say, all right, well, then I'll just come right again and I will do another one right at the money. And if you've told yourself that at the beginning and you say, I think the move is too far, too fast, I believe in this kind of a trade. As a standalone trade, if I were flat, would this be something that I would put on right now? And if you can answer that, yes, you know what? I'd feel okay putting on a double calendar that's got the majority of the profits under the market. Then that adjustment is completely acceptable to put on. A preferred time to put the adjustments on is before you get way out here and you are too far gone underwater. So as soon as you begin taking a little bit of drawdown, or as soon as you start escaping the tent, it's time to consider doing something. That might be 1 day after inception, that might be 3 weeks after inception. Think of it like this. Oh boy, this is gonna make you laugh. This should make somebody laugh. So let's say green, right? We've got green right here. We've got our green thing here. And I don't know how many of you have dogs or pet owners. We have dogs. We've always had dogs. We'll always have dogs. We're just huge dog people. So you have a dog in your yard. Here is your spike steak. I'm not even going to try. I'm not even going to try and draw a dog. But all right, this is what your dog is attached to. And you want to let your dog roam a little bit. He's on a chain, or if just say that this is your invisible fence that you have around the perimeter of your house. If this is your yard, so to speak, and you have your puppy in the backyard, and you want to let him roam around. You don't want to just wedge him in his crate all the time. You want to give him some freedom, let him roam and let him explore. But if he gets too far away, say he gets out here, he's kind of approaching that invisible fence that is supposed to keep him contained. Well, you should be sitting up and taking notice, paying attention. You don't want to just say, yeah, he'll be all right. He'll probably come back. Because then if he gets out here and you're still saying, yeah, he might come back. And then all of a sudden he just bolts and he takes off and he runs away. You're never going to get your dog back. You've lost your dog. He's gone for good, and you stand no chance at recovering him. Now, horrible analogy. I know it's simple put, but I hope you get the point. Preferred time to make an adjustment to some of these trades is begin starting to sit up and take notice, maybe at about this 50-yard line, 50% area, where this is peak profitability, this is zero profitability. When I start getting into this area here, I may sit up and take notice and start considering an adjustment. If I get here, I'm probably really going to be considering something. If I get here, I really have to make some kind of maneuver, either in the form of closing the trade and taking a loss, or adding more capital and margin to the trade and fighting it, or saying, well, you know what? This is a $135 dog, and it was a pound rescue, and I really hope he doesn't run away and never come back. But if he runs away and he comes back, well, then you know what? I'll try and grab him. But if you'd identified that up front, that you were prepared to lose that full $135, but you don't want to put any more to it, let it go. Let it run as far away as it wants, and then it may come back, it may not. But you have to accept that. You have to ask yourself that question in the beginning, at the outset. All right? So I hope that helps. I'm not trying to be silly. I'm truly trying to be very, very serious and very professional and very insightful, but I'm also, I want to have a little fun with it and make the analogy. I want to make the word picture stick, okay? Question number 15, how profitable are calendars in the weeklies? We did a whole video lesson on that. Calendars in the weeklies can be insanely profitable, but again, you have to be accepting of the fact that when they move, they can move quick, and if you only have a handful of days to expiration, if you want to put a trade on in this calendar that in the weekly cycle that expires in 4 days, yes, you are going to receive $2.93 of credit for putting this trade on, but what happened there? I still got something in there? Oh yeah. But you have to understand that you've got very little time. You've got 4 days in which to do something, and just be prepared and be in tune with that. I would say get good at the monthlies and the longer time frames first, and then start experimenting in the weeklies. If you try straight off in the weeklies because, well, you're telling yourself I can get 52 trades a year instead of just 8 or 10, and you get a sour taste in your mouth because you've lost a lot in the weeklies, all right, well, get comfortable driving the old 1975 Ford F-150 pickup that's got dents and faded paint on it first and bald tires. Get used to driving that first, and then start stepping up to the sports car. And in my opinion, the weeklies, they move quick, they move fast, have tons of profit, tons of potential, but you have to absolutely respect them, okay? And they're not for new beginners. That's just my belief. Question 16. What makes a T+0 line elevate or decrease below the x-axis? So Here's an at the money call calendar. We have a T plus 0 line that's relatively flat. What makes that elevate is volatility. All right? Decrease in volatility means if this uniformly decreases, and remember what I said, they don't uniformly decrease. If this dropped 5% and this dropped 5%, this would be your new risk profile. As it stands, this is what your profile is. There's no way in this platform that I know of in OptionView to delineate between front month and back month volatility changes. I wish there was. It would make it a lot more accurate, but this just uniformly tells you volatility change up or down. So I have a minus 5% volatility change in both front and back month. That's what's going to change that T plus 0 line. This drops 5%, this drops 5%. I make a lot of profit on this. I lose even more profit on this, okay? So that's what makes the T plus 0 line elevate or decrease. Question number 17. All right, 1 second here. Okay, so sorry, had to make a quick little pause there. Question number 17. What happens when the T plus 0 line is below the x-axis but still contained within the tent? So, same example. This is the T... Oh, what in the world? Oh, all right. T plus 0 line is right here. Now, let's say you have a decrease in volatility. Let's say it's 2.5%. And your T plus 0 line is crushed because of volatility, but the market price is still within your tent. There is nothing wrong with keeping that trade open, just understanding that if it does move, you're going to begin letting your dog run a little bit farther, a little bit quicker as you get to that expiration break even. So in my opinion, and what I have done in the past is, if as long as I'm under the tent, then these changes in volatility don't necessarily concern me as much as if I get a big change and we begin moving outside of the tent area. All right, question number 18. When should a single calendar be converted into a double, a triple, or even more? I kind of already talked about that. I know that there are some advocates of, well, if this is the trade and I want to put on a single, well, why don't I just do this and go out of the money here and do this and go out of the money here and put on a triple calendar. I'll just put this on, right? I'll just put this on. I've extended my tent to a very wide range. I still have all the benefits of a calendar. It's T plus 0, it's delta neutral, it's theta positive, it's vega positive. You can absolutely do that, but you should experiment before you start putting live money to that. I personally like to let the market tip its hand first and start as a single, and then if you want to convert it into a double as we begin approaching an adjustment point, or even convert it into a triple. There's nothing wrong with that, but make the market prove to you first where it wants to go. So let's say that we had just a very subtle move to the upside. You're not really down any money. You might actually even be up a little bit if a week has gone by. So say 8 days has gone by and you are up to this area right here. You're at that 50% mark. Your trade is going to be up about, $8 on this amount of trade. All right, at that point, go ahead and add a double. Convert it into a triple. Put a double up here, and then if it retraces, put another one down here, and you've converted a triple. But that's my personal flavor. Start as a single. Let the market tell you where it's going to take you. Don't try and force the market to go somewhere you want it to go, because we all know how that ends up, right? 9 times out of 10, 99 times out of 100, it goes exactly where you don't want it to go, and then you're hosed. Question 19. Does IVR figure into the decision-making process for launching calendars? Yes and no, and IVR just specifically means that implied volatility ranking, and that specifically is this right here. Thinkorswim has the ability to look at what is the implied volatility rearward looking over the last 1 year, and it assigns it a ranking number between 0 and 100%. And there are many advocates that say we want to sell premium when that IVR gets above 50. We want to buy premium when IVR gets under 20. Again, just you have to experiment with that, but I look at it. I do not let that influence or guide when I am going to put on a calendar or when I am not. I like to let the price discrepancies or the skew changes influence my decisions more so in some of the calendar trades. All right. And last, but certainly not least, because I am well over an hour now and I'm so sorry. What are realistic expectations for returns on calendars? Now, that's a very sticky question, and it's one I'm not going to answer specifically. But what I will say is a couple of early videos, I showed you specifically using the weekly, some of the most dangerous, fast-moving vehicles out there. If you can follow a very unemotional, mathematical, logical, strict-based approach, close your losers when they lose, keep your winners when they win. It is quite simple to more than beat what you may be currently making right now. All right, and we'll just leave it at that. I don't want to give you specific amounts, but you will very rapidly discover, I think, that if you want to target 10% a year, say for example, that should be rather simple to do. And you may even do it in 1 month. You may do it in 3 months, and then you can experiment with a little more risky type of weekly trades, or try and put a super small percentage into an earnings announcement. But realistically, in the beginning, it's going to take you several months to understand how these even operate and how these perform and how these function. And so when you understand that and you gain that confidence in the skill set, I think you'll be very pleasantly content and blessed with the returns that these calendars can make. And they pale in comparison to what you can make in some butterflies and straddles and condors and various other types of strategies. And I'll close on this note. When you invest the time and you spend the effort and the energy to learn all of them and learn how to overlap them on one another, put inside different types of environments, portfolio margin accounts, or all kinds of different variables that you can overlay strictly following a delta neutral theta positive approach, well, the returns really exponentially increase from there. So on that note, take your time. Don't get discouraged. Be encouraged that if you have the desire and the determination to learn this, I can absolutely help you. I love to help you, and you should learn a lot about this in the process. So, guys, thank you so very much for your time spent listening, watching. Don't hesitate for a moment's notice to send me off any questions, comments, and send me feedback, either positive or negative. If I don't get feedback, I don't know how to improve, and that's all I want to do is get better with subsequent courses. I do have several courses planned for you guys coming in the future, but I am really basing and depending on the feedback I receive in this one to kind of help guide and steer me. So don't hesitate for a moment's notice, please, guys. So thanks again so much. Have a great rest of your day and evening or morning, wherever it is that you're at. And thanks for the time spent. All right, bye-bye.